Well, good evening, everyone. Thank you for coming along this evening. Thanks especially to our MCL students, because I know you've had an afternoon of intense private equity, and you have very valiantly come along for some more. Although hopefully this will be a bit less exacting on you, because Chris will be doing the work rather than you this time. So I'm delighted to introduce this evening's 3CL Distinguished Guest Lecture. You will be aware that our lunchtime seminar series, which I think most of you I see at quite regularly, is sponsored by Travers Smith, which we're extremely grateful for. Travers Smith, as well as being a generous supporter of the Centre for Corporate and Commercial Law, are also generous supporter of the law faculty here generally. And we're delighted to have essentially the man in charge with us tonight, Chris Hale. As well as being the senior partner of Travers Smith, Chris Hale is also one of the world's leading lawyers in private equity. He specialises in UK and international merger and acquisition and buyout work, and in particular founded Travers Smith's private equity group in 1996. Chris acts for institutional investors and management teams on investments and divestments, as well as private equity-backed and large private companies on merger and acquisitions and other corporate matters, as well as being at the cutting edge of private equity practice. Chris also finds the time somehow to lecture and also contribute to journals in his writing. And amongst his numerous publications, he's the author of a very well-known book, Private Equity, a Transactional Analysis, which is now, I believe, in its third edition. Chris has a wealth of experience and expertise, and we're delighted to get some of the benefit of that this evening. And I think when Chris and I first discussed this lecture, I said a lot of people in the faculty have a lot of knowledge of private equity generally, but what we would like to know about is some of the things that are happening at the very cutting edge of private equity at the moment. And obviously Chris is the ideal man to provide those insights. Hence the title of Chris's lecture this evening, Private Equity, the Challenges of Success. So,
yes, thank you, Mark, and thank you for asking me to speak today. I hope for those that were on the deals course just now, this is going to be something that complements and supplements what you've learned, rather than being too much of a good thing. Now, what I'm going to do is say a little bit about what private equity is, where geographically private equity money is invested, and how important it is. I'll look at how private equity works, both at the fund level and the investee company level, before turning to look at, is it a good thing, by certain criteria? Then, finally, looking at the risks associated with it in the eyes of some, and the challenges that I perceive the industry faces at the moment. Now, I didn't actually say to Mark I wouldn't make the audience work. There is going to be a lot packed in, so you need to concentrate, and there are a couple of things I will suggest that we can pick up after I've finished. Now, I'm going to aim to speak for 30 to 40 minutes, leaving room for that discussion at the end and for any questions. So probably best to save the questions until later rather than to ask as I go along. But if somebody's absolutely desperate to ask one, I will try to answer it. So what is private equity? Well, if you take the BVCA, the British Trade Organisation for Private Equity's definition, it is investments in unquoted companies, equity capital in nature, medium to long term, and targeted at companies with growth potential. Now, the term is a generic term, and it covers a lot of investment strategies. There we are. From seed capital investment to the very largest buyouts, reaching in one case in this country to the FTSE 100 in the case of the Boots deal. Most money goes into buyouts, not into venture and development capital. Now, one of the key distinctions between venture and development capital and buyouts, as the name suggests, is that the money that goes into venture and development capital is used to help the underlying companies grow and develop. In buyouts, the money goes in the main to help finance the acquisition of the underlying target company. Important distinctions to bear in mind. Now, the US has been the main driving force from private equity since it really began to expand in the 1980s, as this slide demonstrates. I don't know if you can see it properly, but it shows where private equity money has been invested over each of the years 2014, 15 and 16. And by far the second largest home for private equity capital is Europe. In most years, the UK is by far the most important of the European destinations for private equity money, often accounting for 40% by value and 40% by number of deals in a given year. In the rest of the world, as you see, it's not that significant, although it is growing, or at least the private equity industry hopes it will grow. That therefore means that in the US and the UK in particular, and to a lesser extent in other Western European countries, private equity is very important. And to give you a flavour for how important, according to a Bain report in 2013, private equity-backed companies accounted for 23% of America's mid-sized companies and 11% of its large companies. Those companies together employed 11 or 12 million people. Now, I don't have recent figures for the UK. I do have some dating back to 2008, so nearly 10 years old. An outfit called IEC Consulting undertook some research into this arena, and that research indicated that around 3 million people in the UK at the time, equivalent to 21% of the then current UK private sector workforce, worked for companies that either were or had been financed by private equity. At the time, the research indicated about 8% were employed by those that were in companies private equity backed. Now, I suspect the numbers in the UK are actually larger now rather than smaller than was the case 10 years ago. And as you'll see from this slide, lots of well-known high street names and others you'll be familiar with either are or have recently been backed by private equity companies. For those working in the finance industry, private equity is also very important. According to Preqin, a London-based researcher house, private equity funds effected deals worth $400 billion worldwide in 2015. And the fees each time they buy and sell a company provided a fifth of the global banking system's revenues from M&A. And those numbers will be higher in the US and in the UK. In the UK, according to the Centre for Management Buyout Research, buyouts accounted for 52% by number of deals and 64% by value of deals in the first 9 months of 2017. So a very, very significant part of the UK M&A scene. So when we talk about private equity, what are we talking about? Well, what we're talking about is a variety of asset manager. When private equity really began to develop in the 1980s, most of those asset managers were subsidiaries of banks, so NatWest Equity Partners, now Bridgepoint, Barclays Private Equity, now Equistone, Citicorp Venture Capital, now CVC, or of insurance companies, Prudential Private Management, now Silverfleet. And what happened from the early 1990s onwards was that those subsidiaries were divested, and most private equity houses are now independent fund managers who are owned by those who work for them. There are a few who are not. A few listed entities that are private equity houses, the most prominent of which is 3i, which today invests its balance sheet money rather than investing a fund, although some are hybrids. HG Capital would be a good example. It is an independent listed entity investing its own capital, but also has separate funds that are invested alongside HG's own money. The independent fund managers raise money, as you will see from the slide, from outside investors. And most of that money comes from, as you see from the slide, pension funds, fund of funds and other asset managers, insurance companies and sovereign wealth funds. That accounts for about 3/4 of the money that these independent fund managers manage. The money goes into a limited partnership, which is the common legal structure for a private equity fund. A limited partnership is used because it is tax transparent and it provides the cloak of limited liability for the investors. The general partner in a limited partnership will be an entity under the control owned by probably the private equity firm itself. The limited partnership for a fund, the fund will have a life of 10 years typically. It will have very limited liquidity. There won't be redemption rights. There is a sort of secondary market in limited partner interests, but that's relatively immature. And at the fund level, there will be no borrowings. So you might wonder how private equity fund managers make their money. Well, they make it in two main ways. The first is by charging a fee on the capital committed by the investors. And one thing to understand is that if a pension fund invests in one of these limited partnerships, it doesn't write a cheque for the amount of that investment on day one. The money is cooled down as and when it is needed to make an underlying investment. But the fee will be charged on the committed capital. It used to be 2%, and it is now about 1.5%. On a big fund, that's a lot of money. The other main way private equity firms make money is through what is called the carried interest. So when the underlying investors receive back the money they have invested, and on top of that get an extra return, a hurdle, typically 8%, the money generated by realizations will then be split, typically 80% to the underlying investors, 20% to the private equity firm. And that 20% is what is known as the carry or the carried interest. So let's just turn briefly to how private equity works at the investee, the investment level. Now, this slide, rather sadly, encapsulates how I have spent a large part of the last 30 years. You'll see lots of lines connecting some of the actors on this slide, and most of those lines will result in a contract of some sort. And what private equity lawyers like me spend their time doing, or a large part of it, is negotiating and drafting those contracts that reflect the relationship between these different investors, these different actors. Another way of understanding private equity... before that, I should just explain. When a deal is effected, about half today of the money will come from the banks or, increasingly, alternative debt providers. In this slide, I should just have said debt providers rather than banks. The bulk of the rest of the money will come from the private equity house, which is the investor on the top right, with a very small amount coming from the managers. And by managers, I mean the senior individuals who are going to run the underlying company. The best way of understanding private equity and how it works is to think of it like buying a house with a 98% mortgage. Now, you might wonder, given I've said only 50% comes from debt providers, where the other 48% comes from. Well, the other 48% actually comes from the private equity house, because most of their money, 90-something%, won't go into genuine equity, by which I mean ordinary shares. It'll go into a fixed return instrument. If it's an English structure, it'll typically be a loan note or a preference share. And if your house increases in value, you repay your mortgage, and all the increase in that value, once you've repaid the mortgage, will go to you as the owner. And the same theory works in private equity. Now, the management in a primary buyout don't have to invest in the fixed return instrument. They just have to put what is always a modest amount of money into the genuine ordinary equity. And what that means is that if things go swimmingly well, they will do better proportionately than the private equity house, which is invested most of its money in the fixed return instrument. Of course, if things don't go swimmingly well, their ordinary shares are sitting beneath a stack of debt and won't be worth anything. In most buyouts, the private equity house will own a majority of those ordinary shares, so their return will be a combination of they hope, the increase in value of the ordinary shares and what they get back on the fixed return instrument, the interest or dividends on it typically rolling up and not being on a current paid basis, in contrast to elements of the debt, until an exit, a sale or an IPO, whatever it might be. So, is private equity a good thing? I'm interested in your thoughts on that. I'm looking at it from three perspectives. For the investors, first of all. Clearly, investors in private equity funds actually do think it is a good thing. According to Preqin, the number of private equity firms grew from 24 in 1988 to 6,628 in 2015. And these firms have raised ever-increasing amounts of money over the last 25 years since the independent model I talked about took hold. And there are now today record amounts of committed but uninvested capital in the hands of private equity fund managers, so-called dry powder, and that dry powder now amounts to over $1 trillion. Why have investors committed so much money? Well, the answer must be that they think they obtain a good return from it. One fraught question is whether private equity funds have produced superior returns for investors compared with investments in stock exchange listed investments. And the difficulty in analysing that question is lack of information. Investors in private equity funds and the fund managers tend to keep that information to themselves. It's also difficult to compare on an apples with apples basis. However, data sets are gradually becoming more readily available, and so-called public market equivalent measures are being developed to try and compare private equity with public market investments on a like-for-like basis. Most of the research I have seen, but not all, does indicate that over most periods and using most criteria, private equity does produce a superior return to an investment in the listed environment. Now, we can debate later, and I'm interested in your thoughts on this, why this might be the case. What about the picture for employees in investee companies? Well, you can look at that in a number of ways. The most popular are to look at the effect of companies that are backed by private equity houses on employment in those companies, and the second is to look at what happens to wages of those employees. There's been quite a bit of research on the former, some but not much on the latter. Regrettably, though, the research, such as it is, does not provide a clear answer as to whether for employees, at least on those two criteria, working for a private equity house is a good or a bad thing. For the senior managers and others who may be equity incentivized in the way I've described, it probably is a good thing. A lot of people I know have made a lot of money out of successful investments as managers in private equity entities. What then about the wider economy? One way of examining that question would be to ask, do private equity-backed companies invest more? Do they innovate more? Do they become more efficient? Private equity firms would give a resounding yes to the last part of that question. But again, there is an absence of data to answer the components of the question. A further way of looking at it, and this does bring us into the sort of challenge territory, is to look at whether there are particular risks associated with private equity that are not good for the wider economy. So does private equity pose systemic risk? Now, you might have gathered from what I've said that I don't think it does, but we can debate that when I've finished talking, and I'll be interested to know what your analysis would be. Does private equity pose systemic risks? does it produce excessive leverage that might result in a higher failure rate for private equity-backed companies? It's certainly been criticised for increasing financial distress and bankruptcy, especially following a financial crisis. Now, there has been some research that is pretty evidence-based on this subject. The most interesting piece of work I've read is by Mike Wright of Imperial College Business School and Nick Wilson of Leeds University Business School. And they have produced an article, this was 3 or 4 years ago, summarising their research. And the abstract from the article reads as follows: we build a unique data set comprising the population of over 9 million company year observations and 153,000 insolvencies during 1995 to 2010. We compare the insolvency hazard of the spectrum of buyout types within the corporate population over time and investigate the risk profile of the companies pre-buyout. Controlling for size, age, sector and macroeconomic conditions, private equity-backed buyouts are no more prone to insolvency than non-buyouts or other types of management buy-ins. Moreover, leverage is not the characteristic that distinguishes failed buyouts from those surviving. So in other words, excessive leverage isn't a feature of private equity and not a feature that produces more distress and insolvency. I've got a copy of the article here, actually, if you want to read it. Private equity undoubtedly does throw off conflicts of interest. And that, in an FSA, as it then was, report from the early 2000s was something that was highlighted by the FSA as a high risk in relation to private equity. Worth a read if you're interested in the private equity subject. That's the report there. So just have a look at the conflicts of interest, or certain of them. For example, where an employee of the private equity firm is also acting as a director of the underlying investee company, a conflict may arise between their personal responsibility to the investee company and their responsibility to the fund for which they work or the underlying investors. And that conflict can arise in particular when a company is in distress. Conflicts can arise between investors in separate funds that may be run concurrently by the same manager and invested in the same underlying company. Now, in my experience, those type of conflicts are actually extremely well managed in the private equity world and not ones to be frightened of. The area where conflicts are less well managed, and this is again my personal view based on working in the industry for a long time, is that the remuneration of private equity managers that I've described, particularly the fee bit of it, and the fundraising cycle, both drive or can drive distorting behaviour that is not necessarily in the interests of the underlying investors in a fund. So, to take an example, the desire of a private equity fund manager to raise a new fund may cause it to exit an investment in a prior fund earlier than might be in the interest of the underlying investors, simply to show an exit track record when it is raising the next fund. Managing these conflicts is likely to become an area of greater focus in the future and challenge for private equity for some of the reasons I'm about to come on to. Now, turning to key challenges, one of the most immediate is one you will have guessed at, given what I've said about dry powder, and that is investing the record amounts of dry powder that are available. There are simply too few attractive assets to invest in, and the other feature of the M&A landscape today is that the competition for those assets has broadened out. So it's broadened out because some limited partners are now investing directly rather than through funds, so competing with those they used to provide money with to manage. Family offices have appeared on the scene, adopting private equity style investing and doing quite substantial deals. Chinese entities have appeared on the M&A scene in Western Europe and in particular in the UK, focused on deploying more capital abroad. And there are other buyers that are now on the scene that weren't there before. So the combination is that competition for attractive assets is intense, driving up prices and threatening longer-term returns for private equity fund managers. The other danger is that they won't actually be able to find enough assets to invest in and will have to return money to their underlying investors, which is always the last thing they want to do. Now, in view of the market turmoil of the last 3 or 4 years, I rather presciently ask what happens, I did these slides before the turmoil, what happens when quantitative easing ceases and interest rates go up, I should have said, and when the spectre of inflation reappears. Well, the answer over the last 2 or 3 days is that the public markets appear to correct in quite a major way, and the immediate issue is whether that is just a blip or whether it is something more than that. I mean, I happen to believe, and I think most commentators agree with this, it is just a needed correction after the over-exuberance perhaps, of the early weeks of 2018. And that's in part because the last feature of my question is not apparent at the moment. There isn't a recession looming. The underlying fundamentals of most economies seem to be strong. Nevertheless, in these circumstances, it will produce challenges to private equity, and they will arise sooner or later. And those challenges arise because a lot of the underlying investors, the pension funds, allocated a certain percentage of their assets to private equity. And that percentage is in part dependent on the value of some of their other assets, in particular their investments in the public markets. So to the extent public markets go down, the private equity allocation is squeezed and they're less inclined to put money to work with private equity. The other thing that may make fundraising for private equity more difficult is that if interest rates do go up and inflation takes hold, there are likely to be more yielding instruments for investors to invest in. One reason private equity has been so attractive in recent years is that interest rates have been so low that there have been very few attractive yielding instruments and investments available, and that has driven quite a bit of money into private equity. So it's a challenge that will emerge for private equity sooner or later. Another challenge for private equity is the increasing burden of regulation. For most of my time as a practitioner, it's been a relatively unregulated world, but that has changed quite dramatically in the last 10 years. The first pan-European regulation of private equity was the AIFMD regulation, the Alternative Investment Fund Managers Directive. Invest Europe, which is the trade body for private equity across Europe, commissioned some research very recently into the effectiveness of AIFMD. Their report was published in December, and perhaps not surprisingly, it concludes as follows. The high-level conclusion that could be drawn from our research is that the AIFMD produced relatively insignificant benefits in the private equity industry, but at a relatively high cost. The latter includes both direct compliance costs and unintended consequences which might retard the growth of the industry. One such unintended consequence, following from inconsistencies in the AIFMD's implementation, is the creation of a barrier for non-EU managers to market their funds in the EU, effectively discriminating against non-European GPs, and also reducing the universe of funds LPs can invest in. And there are a myriad of other laws that have emerged recently which private equity houses now have to comply with, from complex UK tax rules on the carry to detailed FCA requirements for private equity houses licensed in London. The upshot is a significant increase in the cost base for private equity firms. In most cases, they now employ lawyers, tax experts and compliance officers in the way they did not do a dozen years ago. This means greater expense, and the evidence is that is shared between LPs and the GP, between the underlying investors and the private equity house. It produces a challenge because it's going to eat into returns and potentially provides a barrier to entry for new private equity fund managers, although there are still quite a lot being created and established. In the lead up to the financial crisis, private equity was investing in ever larger companies and began to attract wider attention. The broader stakeholder community was interested in who owned companies they did business with, for example, Boots, the FTSE 100 take private I referred to earlier. Private equity became the subject of vocal criticism from unions, politicians and others who characterise private equity as a group of tax-avoiding asset strippers out for themselves. Unfortunately, private equity, the emphasis was on the first word, responded slowly and rather ineptly. It's since improved its public relations, but as private equity retreated into smaller deals after the financial crisis, attention waned. With the return of mega funds, and by that I mean funds of $10 billion or more, and we've seen a number raised in the last 12 months, what we will see is big deals. And that is likely to return the spotlight to the industry. There's something else that's going to compound that, which is the increased disclosure requirements being imposed on private equity. There were some, as you may know, in AIFMD, but there are others that are coming. And the combination is likely to be more attention on the industry. That is going to be a challenge, and how it responds to it, given its experiences 10 years ago, is something we'll all be interested to see. That transparency is also likely to focus more sharply attention on two other areas that come up periodically for attention. One is the fee levels that private equity charges. Now, the reason some limited partners are investing directly is that they want to avoid the fees that I described that private equity charges, which, by comparison with the fees charged by other asset managers, are very large. I think it's going to be an increasing challenge for private equity over time as disclosure becomes greater and greater for them to justify those fee levels. The second area of focus is tax, and that pops up periodically. I have to say there is some justification in the charge that private equity is good at avoiding tax. It is. It's had for a long time advantages in that interest on the debt in the underlying investee companies that I talked about, the external third-party debt and the fixed price instrument, if it's a loan, have for most of my career been tax deductible in the hands of the investee company. Now, that's being eaten away at, and that itself may reduce returns. The other and more controversial area for focus in relation to tax is the way the carry is taxed. It's taxed in pretty well all jurisdictions as a capital gain, and a lot of people, since the underlying fund managers put very little of their own capital at risk, a lot of people say, well, why is that different to what a lawyer or investment banker or another asset manager who's probably going to be remunerated by a bonus, why is that taxed differently? It's not that easy to justify. Now, Donald Trump said he was going to change the tax treatment of the carry, but as with most things that Donald Trump says, you shouldn't take too much notice of them. What you should do is look at what he does, and in the recent act that Congress has passed, the carry seems to have escaped. But that is going to recur as a subject for debate and is going to present one of the other challenges for private equity. Now, a talk in the UK would not be complete without a reference to Brexit. And Brexit is going to produce some challenges for private equity. One is relatively immediate, and one is less certain and longer term. The more immediate one relates to London. London is the main portal for private equity investment through Europe. It's probably the biggest private equity portal in the world. Most fund managers, private equity fund managers, are based in London and have a license in London that enables them to operate throughout the EU and in particular to raise money from EU institutions. Once this country leaves the EU, that passport won't be available. Now, there are private placement regimes that are available which would be open to private equity houses to take advantage of and remain licensed only in London. I suspect they won't do that because they vary from one country to another. At various times recently, the EU said it wants to get rid of them. Whether they will or not, I don't know, but that's what they've said. And that means, therefore, to raise money from EU institutions and operate within the EU, a license will be required from an EU 27 country. At the moment, what private equity houses in the main are doing is preparing the ground for doing that without actually pressing the button to do so, although the time will come soon when they will do that. One of the key issues for them is how many people they will have to move. The jurisdiction that is favoured by private equity for this is Luxembourg. The trouble with Luxembourg is that it is small and doesn't have quite the, I mean, a lovely country and a lovely city, I'm sure, but doesn't have quite the attractions of London. And all sorts of considerations like schools come into play. Most private equity fund managers, for all those sort of slightly intangible reasons, would prefer to stay in London. That is an evolving subject, and we will have to see exactly where it lands. So that is an immediate challenge for private equity. The longer term one relates to the UK and the UK economy. If, as some predict, the UK economy becomes a lower growth economy compared with other main economies in the EU, it's likely in big picture terms to become a less attractive place in which to invest money, meaning that many private equity firms may choose to place their bets in Germany, Holland, Spain, Scandinavia, and that will in turn produce challenges for their internal structure. So where do they put their people? Is London such a good location? If that is what is going to happen? So there will be some challenges if that analysis is right beyond the pure licensing arrangements that I was just describing. Now, I've outlined many challenges for private equity, a number resulting from the industry's success over the last 25 or more years. I'm confident that the industry will rise to them, not least because private equity has become one of the most attractive places to work for the best and brightest graduates from our leading universities. And there's a bit of careers advice to finish with. If you're thinking of a career in finance, don't ignore private equity. So it will, in my view, remain a mainstream part of corporate finance, and private equity will remain part of a well-diversified investment portfolio into the distant future. Now, I think I've spoken for between 30 and 40 minutes, so now is the time to ask questions or to start the debate on the issues that I mentioned or some others.